This week, Nifty added 0.5%. Oil came off its highs. The rupee pulled back from its worst levels. On the surface, are quite weak, but under the surface, the Iran war is still running. There is a new Federal Reserve chair in Washington. I'm Siddique. Welcome to the first episode of Chai with Siddique. Sit back. Let us talk about what this week really meant for your money. Let me start with India. Nifty 50 ended the week at 23,719, a gain of about 0.5% for the week. Sensex at 75,415, both indices finished positive, and importantly, Friday was a strong day. Markets were calm. The selling we saw earlier this month seems to be settling. Now the United States, the S&P 500, this is the main index we track for global health, had a mixed week. Wednesday was strong. Markets recovered from a 3 day losing streak. Thursday was softer. Treasury yields came back up, and that put pressure on tech stocks. The takeaway, US markets are in a tug of war between optimism on trade deals and worry about inflation staying high because of oil. And the big global story that is hanging over everything, oil. Brent crude is at $104 a barrel. It was 107 just a few days ago. It is coming down slightly, and that is the good news for India, but it is still very high. The Iran war, which began about 2.5 months ago, has kept oil elevated. Shipping through the Strait of Hormuz, the world's most important oil shipping lane, is still at just 5% of its pre war levels. Let that sink in. 5%. For NRIs watching from the UAE, I want to say this clearly. The ceasefire is holding but fragile. The situation in the Gulf is tense but not escalating further right now. We will keep watching. This week, I want to talk about the rupee and an opportunity that many NRIs are sleeping on. The rupee peaked at 96.79 against the dollar earlier this week. That is near an all time low. As of Friday, it has pulled back slightly to 95.93. For most people, that sounds like noise. For an NRI in the UAE, that is actually very significant. Here is the simple math. Your dirham is pegged to the dollar at the fixed rate of 3.67. So today, 1 dirham buys you roughly 26.13 rupees. That is near the highest it has ever been in history. 1 year ago, the same dirham bought you 23 to 24 rupees. You are getting almost 10 to 12% more rupees for every dirham today compared to last year. Now, what does this mean practically? First, if you are sending money home for family expenses, EMIs, or parents, this is a good time. You are getting excellent value on remittances. Second, and this is the bigger point for investors, if you have been wanting to add to your Indian equity exposure, this is a double discount moment. Nifty has corrected from its highs and the rupee is weak. So every dirham you send across buys you more Indian equity than it did a year ago. Both the market and the currency are working in your favor. Now, the honest risk picture, oil at $104 is still not comfortable for India. Every dollar oil goes up, India's import bill goes up, the current account deficit widens, and the rupee gets pressure. If Iran tensions flare again and oil goes back above 110, expect the rupee to weaken again. Also, the new Federal Reserve Chair Jerome Powell's term ended on May 15th. There is a new phase in Washington. JP Morgan's view is that the Fed holds rates steady for the rest of this year with a possible hike in 2027. For us as investors in India and globally, higher US rates for longer means foreign money stays in dollar and does not flow into emerging markets like India. That is a headwind. So, where does that leave you? If you are a long term investor, stay disciplined, continue your SIPs. If you have cash sitting idle and you have been waiting for a good entry point into Indian equity, the combination of rupee weakness and market correction is one of the better windows you will see. But do not go all in at once. Stage your entry 3 to 4 tranches over the next 2 to 3 months. Three things to watch next week. One, US core PCE data, Thursday, May 28. This is the Fed's preferred inflation gauge. If inflation is higher than expected, expect bond yields to rise and markets to sell off. This number will set the tone for June. Two, US GDP's second estimate, also Thursday. If growth is being revised down, combined with high inflation, that is stagflation territory, the worst possible combination for markets. Watch this closely. Three, oil and the Strait of Hormuz. Any news of fresh attacks or ceasefire breakdown in the Iran conflict will move oil immediately, and oil moves everything else. Rupee, Indian markets, your cost of living. That is the week that was. Markets absorbing a lot of noise but not breaking. India holding up well. The rupee giving NRIs an interesting window. And the big risk, oil, Iran, Fed, is still present but not getting worse this week. My message to you, and this is why I started this show, is that you do not need to react to every week. You need to understand every week. There is a difference. One leads to panic, the other leads to good decisions over time. If this format works for you, hit subscribe. Every Saturday morning, we sit down with a chai and we talk markets. No jargon, no noise, just what matters for your portfolio. Tell me in the comments, are you based in UAE or elsewhere? Are you investing in India, globally, or both? I read every comment, and your questions shape next week's episode. This is Siddique. Have a great weekend. I will see you next Saturday.